If I were to ask you right now, who really owns the US dollar? I mean, who is the ultimate owner of the Federal Reserve?
Hmm.
Most of us, and I was definitely in this boat until we started this, would probably just say the government, right? Or maybe the American people.
It's the knee-jerk answer. And it's understandable. The name itself, the Federal Reserve System, it sounds official. It sounds governmental.
Okay, it has federal in the name, so you assume it's run by civil servants accountable to Washington.
But that's the first assumption we have to just throw out the window.
And that's what this deep dive is all about. We're going to conduct a forensic investigation, really, into the Fed's corporate charter. Because the minute you look at it, you realize the Fed is about as federal as, Federal Express.
That's a great way to put it. Legally, it's a private corporation. It operates under a charter from Congress, but it's a private entity.
And that means it has things that private companies have. It has stock, it has shareholders.
And it pays dividends. Millions of dollars in dividends every single year to those shareholders. It's a business, or at the very least, a very, very specialized utility for its members.
But here's the catch, and this is where it gets interesting. You can't buy a share. I can't call up my broker and say, get me 100 shares of the New York Fed. The president can't do it. It's a closed club.
A mandatory club, in fact.
So our mission today is to pry open the books, specifically of the New York Fed, because that's the most powerful one, and find out exactly who holds the stock certificates, who owns the printing press.
Right, and we have to focus on the New York Fed. There are 12 regional banks, but the NY Fed is the engine room. It's the one that actually does the trading. It holds the gold for other countries. It manages the critical repo market.
It's the operational arm.
It is the operational arm. If you want to know who really has their hands on the levers of the system, you have to look at who owns the NY Fed.
And when you do that, when you actually reverse engineer the ownership based on their own rules, the number you come up with is, well, it's frankly shocking.
It is.
It looks like almost 3/4 of this incredibly powerful institution is owned by just 2 companies. And that one fact forces us to ask the big question. Is this a public utility or is it a private cartel? Okay. Let's get right into the data. This is the smoking gun of our entire investigation. We're zeroing in on the New York Fed because, as you said, that's where the action is. Its balance sheet, its operations, they dwarf the others.
And we can actually figure out the ownership percentages pretty precisely because the Federal Reserve Act of 1913 lays out the rules very clearly.
It's not a secret. It's just obscured.
It's just not advertised. The rule is this. If you're a nationally chartered commercial bank, you must join the Federal Reserve System. It's not optional. And to join, you are mandated to buy stock in your district's Federal Reserve Bank.
Okay, so it's a mandatory buy-in. How much stock do they have to buy?
And this is the key part. A member bank has to purchase stock equal to exactly 6% of its own capital and surplus.
Let's break that down. Capital and surplus, what does that mean in simple terms?
It's basically the bank's net worth. Think of it as its core equity, its permanent capital, all its retained earnings. It's the financial cushion of the bank.
So the bigger the bank, the bigger its capital and surplus.
Exactly. And therefore, the more Fed stock it is required to buy. The system's designed so that the largest banks automatically become the largest shareholders. Their size dictates their ownership stake.
So when you apply that formula to the New York district, which is, home to Wall Street and the biggest global banks, the picture becomes incredibly clear.
Incredibly concentrated. When you run the numbers based on those required capital contributions, the single largest shareholder in the Federal Reserve Bank of New York is Citibank.
And what's their stake?
Citibank owns approximately 42% of the total capital stock.
42. Let that sink in. That is almost half of the entire engine room of the global financial system owned by a single private corporation.
And right behind them, the second largest shareholder is JPMorgan Chase.
Okay.
JPM owns about 29% of the New York Fed's capital stock.
So wait, let me just do the math here. 42% for Citi, 29% for JPM. That's 71%.
71%.
2 banks, 2 private competing banks together control 71% of the shares in the New York Fed.
It's not just a majority. It's a supermajority. They don't just have a voice. They are the dominant voice in that shareholder group.
This just completely shatters the idea that this is a government agency. I mean, in what universe is an entity 71% owned by 2 private companies considered public?
It's not. And we have to be clear about what that ownership translates to. Does it mean Jamie Dimon can call up the Fed and tell them where to set interest rates? No.
Okay, so it's not a direct line.
No, the final say on the federal funds rate rests with the FOMC in Washington. But that 71% ownership gives them immense power. at the local operational level of the New York Fed. In any corporation, if you own 71%, you control the shareholder meetings. You get to approve the budget.
So they approved the New York Fed's budget.
Yes. They approve how it spends its money, its operational priorities, major purchases like real estate, new technology. They control the infrastructure.
So the government in D.C. might set the broad policy, but the 71% shareholders control the resources and the machinery that actually executes that policy.
That's a perfect analogy. It's a difference between Congress passing a law and the Treasury deciding which specific contractors get the money to implement it. One is theory, the other's practice.
And the other banks? Morgan Stanley, Goldman.
They're in there, of course.
Yeah.
They hold smaller stakes, as do hundreds of smaller regional banks, but they're all splitting up the remaining 29%. The lion's share, the real controlling interest, rests with those two giants.
So this is less a regulator and more like a joint venture, a high-stakes joint venture between, effectively, Jamie Dimon at JPMorgan and Jane Fraser at Citi.
Structurally, yes. They are aligned in controlling the very institution that is designed to regulate them and, more importantly, to backstop them in a crisis.
The incentives here are just screamingly obvious. The New York Fed's primary operational goal can't just be fighting inflation for you and me. It has to be ensuring the stability and liquidity of its biggest shareholder.
By design. The system is structurally compelled to serve their health above all else, because if they go down, the whole system goes down.
The fox isn't just guarding the henhouse. The fox designed the henhouse, owns the land it's on, and writes the security budget.
And to understand why it was built this way, you can't just look at the rules today. You have to go all the way back to the moment the system was first dreamed up.
Okay, so to really get why this 71% number exists, we have to go back in time, right? Back before 1913. What did the world look like then?
It was, to put it mildly, financial chaos. The late 19th and early 20th centuries were just rife with banking panics. There was no safety net.
No FDIC, no deposit insurance, none of that.
None of it. Banks were more regional, trust was fragile, and if a rumor started that a bank was in trouble, you'd get a bank run. People would literally run to the bank to pull their cash out.
And because of fractional reserve banking, even a healthy bank couldn't survive a run. The fear would just spread like a virus from one bank to the next.
And the government was basically powerless to stop it. The Treasury could do a few things here and there, but there was no coordinated, centralized authority to inject liquidity and restore confidence.
Until one specific crisis broke the whole system, the panic of 1907.
That was the big one. That was the catalyst. It started with a failed stock market speculation, an attempt to corner the market on United Copper Company stock, but it spiraled out of control very, very quickly.
The brokerage that failed had ties to a major trust company in New York, the Knickerbocker Trust.
Exactly. And when the Knickerbocker went under, all hell broke loose. The public lost all faith. The run started everywhere. The entire system was on the brink of a complete meltdown.
And the government couldn't do anything. They were just watching it burn.
So who stepped in? One man. JPMorgan.
The man, not the bank.
JPMorgan, the individual. He became the de facto central bank of the United States. He used his own capital, his firm's capital, and his immense personal authority.
And there's that famous story, right, where he literally locked the city's top bankers in his library.
That's right, in his magnificent library on Madison Avenue. He gathered the heads of the other big banks and trust companies, locked the doors, and basically told them no one was leaving until they coughed up the capital to bail out the failing institutions.
He strong-armed them into creating a private bailout fund.
He did, and it worked. He stabilized the system. But everyone, especially Morgan himself, realized this was completely unsustainable. The entire U.S. economy couldn't rely on the health, wealth, and, well, the mortality of one single person.
No matter how magnificent his mustache was.
Right. They needed a permanent, institutionalized version of JPMorgan, a lender of last resort that was always there.
But, and this is the crucial part, the bankers wanted to make sure they were the ones who controlled this new institution. They did not want to hand the keys over to politicians in Washington.
Absolutely not. They saw politicians as unpredictable, subject to populist whims. They wanted a system run by professionals, by bankers, that would have the full authority and backing of the government.
Which leads us directly to one of the most famous secret meetings in American history, Jekyll Island, 1910.
The scene is almost cinematic. A handful of the most powerful men in the world, representing something like a quarter of the world's wealth at the time, boarded a private train car in New Jersey.
Who was there?
You had Senator Nelson Aldrich, who was the political face of the operation. You had A. Piatt Andrew from the Treasury. But the key players were the bankers. Henry Davison from JPMorgan and Co., Paul Warburg, who was a brilliant German banker with the blueprint for a central bank in his head, and Frank Vanderlip, the president of National Citibank.
National Citibank. That's a forerunner of Citibank.
The very same. So you have Morgan and Citi's predecessors right there in the room, literally writing the blueprint.
And they did this in total secrecy. They traveled under assumed names, told their families they were going duck hunting.
The blinds on the train car were drawn. They got off at a remote stop in Georgia and were taken to the exclusive Jekyll Island Club. They knew that if the public caught wind that a cartel of Wall Street bankers was writing the legislation for a central bank, it would be dead on arrival. The American public was deeply suspicious of centralized financial power.
So for 10 days, they hammered out the plan. What was their main goal?
The goal was to create a system that looked public but was privately controlled. They wanted the authority of the government, the power to issue currency, to be the official banker for the U.S. Treasury, but they wanted the operational control to remain in the hands of the banks.
So the structure we see today with the 12 regional banks, that was part of the disguise.
It was a brilliant piece of political stagecraft. The original plan was for one central bank, but that sounded too much like the Bank of England, which was a non-starter politically. So they created this decentralized system with 12 banks to make it look like power was spread out across the country.
But they knew that because New York was the financial center, the New York Fed would always be first among equals.
They designed it that way. By mandating that ownership be tied to a bank's size, they guaranteed that the biggest banks in New York would dominate the most important piece of the system.
So when we see that 71% ownership number today held by Citi and JPM, that's not an accident or a flaw that developed over time.
Not at all. It is the perfect, uninterrupted execution of the original design, drafted in secret by their predecessors a century ago. The system was built by bankers, for bankers, and the ownership structure is the primary proof.
Okay, so this brings us to what we can call the country club analogy. To get access to all the perks of the system, the stability, the services, and especially that emergency lending window, you have to be a member.
Right, and membership isn't optional for these big banks. And it's not free.
You have to pay your dues. And those dues are paid by buying this capital stock.
This compulsory stock purchase.
Yeah.
The 6% of capital and surplus we talked about. It is quite literally your non-negotiable entrance fee to the club.
So let's play devil's advocate for a second. What's the official justification for this? The Fed would argue this is a sound regulatory tool, right? That it ensures the members have skin in the game.
That's the argument on paper. That by forcing them to contribute capital, you align their interests with the stability of the entire system. And, there's some logic to that. But in practice, it's a required buy-in to a private utility that primarily benefits its biggest members. The capital they contribute is real, but the power and the access they get in return is far more valuable. It's less about skin in the game and more about owning the game.
Because their sheer size mandates their control. JPM and Citi aren't choosing to own 71%. The rules of the club force them to, which just reinforces the original Jekyll Island design.
Exactly. And what made this mandatory stock so attractive, what made paying the dues so incredibly lucrative for 100 years, was the second part of the deal, the guaranteed payout.
The dividend.
This is a crucial point. Let's really dig into this. For a full century, from 1913 all the way until 2015, what was the dividend on this Fed stock? A guaranteed 6%. Annually.
A guaranteed 6% return. You really have to pause and think about what that means.
I mean, think about any other investment. U.S. Treasuries, the safest asset in the world, their yields go up and down with the market. Corporate bonds have default risk. The stock market is obviously volatile.
But this Fed stock, which you were forced to buy, paid you 6% every year, like clockwork, guaranteed by a congressional charter.
It was effectively a risk-free annuity paid to the largest banks in the world. Compare that to what a regular person was getting on their savings account for much of that time.
Yeah.
Maybe 0.01%.
So in a low-interest rate environment, this was just a fire hose of free, risk-free money pouring back to the shareholders.
It was arguably one of the best, most stable trades in financial history, and is only available to members of the club.
The optics of this must have gotten pretty bad, especially after the 2008 crisis.
Oh, they got terrible. The public started to realize that the same banks being bailed out with taxpayer money were also collecting a guaranteed 6% dividend from the very quasi-governmental entity that was organizing the bailout.
The criticism became impossible to ignore.
Right. So Congress finally stepped in. In 2015, they passed something called the FAST Act, Fixing America's Surface Transportation Act, of all things.
Buried in a transportation bill.
Buried in a transportation bill was a major change to the Fed's dividend policy.
And what did it change?
It created a two-tiered system. For smaller banks, those with assets under $10 billion, nothing changed. They still get their guaranteed 6%.
Okay.
But for the big guys, Citi, JPM, the 71% owners, the rule changed. They now receive the lesser of 6% or the high yield of the 10-year Treasury note.
So their jackpot got smaller.
It did. For several years after 2015, the 10-year yield was very low, 1.5%, 2%, so their dividend dropped significantly.
But what about now, when rates are higher?
Well, now that the 10 years has been up around 4.5%, they're collecting that higher yield. It's still capped at 6%. But the key thing is the risk profile is still zero. It's a guaranteed yield on a mandatory asset.
It's still free money, even if the amount fluctuates.
It is. But honestly, the dividend, as nice as it is, was never the main prize.
What was?
The control, that stock certificate is the ticket. It's the key that unlocks the door to real influence inside the New York Fed. That's the real value.
And this is where we get into the really nuanced part of this whole thing, the mechanics of soft power. So let's be absolutely clear again. Owning 71% of the stock does not mean Jamie Dimon gets a vote on interest rates.
Absolutely not. That's not how it works. We have to look at the two sides of the Fed. There's the public side, which is the Board of Governors in Washington, D.C.
7 governors, including the chair, Jerome Powell, all appointed by the president, confirmed by the Senate. They're the political appointees. Right. And they, along with 5 of the regional Fed presidents, make up the Federal Open Market Committee, the FOMC. That's who sets the federal funds rate. The public side clearly has the voting majority there.
So if the power isn't there, where does the 71% ownership translate into real influence?
It happens at the regional level, specifically at the board of directors of the New York Fed. That is the leverage point.
Okay, so like any corporation, the NY Fed has a board. How does it structured?
It's a 9-member board, and it's divided into 3 different classes of directors: Class A, Class B, and Class C. And this is where the private shareholder power is just hardwired into the system.
Let's walk through them. Who are the Class A directors?
The 3 Class A directors are elected by the member banks, so by the 71% shareholders and others, and they are required to be bankers themselves. They directly represent the shareholder banks.
Okay, so that's 3 seats for the banks. What about Class B?
The 3 Class B directors are also elected by the member banks. The only difference is they're supposed to represent the public commerce agriculture industry. They can't be an officer or employee of a bank.
Wait, hold on a second. They're elected by the banks, but they represent the public.
That's the design.
So the banks are choosing their own public representatives. That means 6 of the 9 board members, 2/3 of the board, are chosen directly by the shareholder base, which we know is dominated by Citi and JPM.
That is the structural conflict of interest that's been there since day one. The private shareholders have a permanent, built-in 2/3 majority on the board.
And the other 3, the Class C directors.
The final 3, the Class C directors, are the truly public ones. They are appointed by the Board of Governors in D.C. to represent the public interest.
So it's 6 votes elected by the banks versus 3 votes appointed by the government. The banks win that vote every single time.
Every time.
So why is controlling this board so important? What does this board actually do?
Well, as we said, they approve the budget, they oversee operations, but their single most critical function is that they get to hire one person.
And that person is?
The president of the Federal Reserve Bank of New York.
Ah. And this is the connection to national policy.
This is the entire ballgame. Because of all 12 regional Fed presidents, the New York Fed president is the only one who has a permanent voting seat on the FOMC.
Wait, the others rotate?
All the other 11 presidents rotate their voting seats. They get a vote every 2 or 3 years.
Yeah.
But the New York vote is permanent. It's sacred. The NY Fed president is always at the table with a vote on interest rates.
So let's trace this feedback loop. The biggest banks, the 71% owners, elect 6 of the 9 directors on the NY Fed's board. That board then handpicks the NY Fed president. And that president has a permanent seat on the committee that sets national interest rate policy.
You've got it. It is an extraordinary built-in mechanism for influence. It's regulatory capture by design.
So the regulated are basically hiring the person who runs the operations of their primary regulator.
And who then gets a powerful permanent voice in setting the rules of the game for the entire country. They ensure the person in that chair is someone who understands their world, who speaks their language, and who will, above all, prioritize the stability of the interbank system.
Now, there's a check on this, isn't there? The Board of Governors in D.C. has to approve their choice for NY Fed president.
They do, it's true. But it's more of a final veto power than a selection power. The entire search, the vetting, the interviews, that's all handled by the NY Fed's board, the one controlled by the private banks.
So they control the candidate pool. D.C. just gets to approve the final candidate from a pre-selected list.
Precisely. The system ensures that only candidates who are philosophically aligned with the core mission of shareholder stability will even be considered. It's not about bribery or overt corruption. It's about a deep, structural, institutional alignment of interests.
And that's the soft power. It's not a command, it's influence. It's ensuring that when a crisis hits, the person running the engine room thinks first and foremost about keeping the plumbing from clogging for the 71% owners. So, we've laid out all the evidence. We've got the 71% ownership stake. We've traced the origin back to Jekyll Island. We've dissected the soft power mechanism of the board of directors. It's time to deliver the verdict. Is the Fed a public utility or is it a private cartel?
Well, the evidence points overwhelmingly in one direction. While the Fed does perform some functions of a public utility, clearing checks, managing treasury auctions, that's not its core purpose.
What is its core purpose based on this design?
Its core purpose, the reason it was conceived in that secret meeting in 1910, and the reason it's structured the way it is today, is to ensure the survival of its major shareholders. It's a backstop. Its prime directive is to keep institutions like JPMorgan and Citibank liquid and operational.
The system is built by banks, for banks.
It is. And to really see this in action, we just need to look at the one thing that keeps the 71% owners up at night. The repo market. This is the plumbing we mentioned.
Explain what the repo market is. Why is it so existentially important for these huge banks?
So the repo, or repurchase agreement market, is essentially a giant, secured pawn shop for financial institutions. It's where a bank like Citi can take a high-quality asset, usually a U.S. Treasury bond, and get cash for it overnight.
So they sell the Treasury with a promise to buy it back the next day.
Exactly, at a slightly higher price. And that tiny price difference is the interest rate on an overnight loan. This market is where trillions of dollars change hands every single day, just allowing these massive firms to manage their daily cash needs. It is the absolute bedrock of short-term finance.
And what happens if that market freezes up?
The entire global financial system stops. If banks can't get that overnight cash, they can't fund their operations. They face immediate failure.
Right.
This isn't a theoretical risk. We saw it happen.
In September 2019.
September 2019. For reasons that are still debated, the repo rate suddenly spiked. It shot up from about 2% to nearly 10% in a matter of hours. The plumbing completely seized up. There wasn't enough cash in the system.
So what did the New York Fed do? The institution whose board is controlled by the 71% owners?
It did exactly what it was designed to do. It intervened massively, immediately. It began injecting hundreds of billions of dollars of cash into the repo market, day after day after day.
And this intervention wasn't about fighting inflation for consumers or maximizing employment?
Not at all. It was a direct surgical operation to unclog the plumbing and provide emergency liquidity to its primary shareholders. It was the New York Fed acting as the lender of last resort, fulfilling the mission laid out on Jekyll Island, protect the banks.
And that contrast just says it all. What are you, the listener, worried about? The price of groceries, the price of gas, consumer inflation?
What is a shareholder like JPMorgan worried about? An interbank liquidity crisis that could bankrupt them in an afternoon.
And when those two priorities are in conflict, the structure of the system, the 71% ownership, the permanent vote on the FOMC, it all pushes the institution to solve the banker's problem first.
Always. Because in their view, and in the design of the system, the failure of the 71% owners is the systemic collapse the Fed was created to prevent. Their health is, by definition, the top priority.
So let's tick the boxes for the private cartel verdict. You have a compulsory entrance fee to join the club.
Check.
Membership grants structural control over the board of directors.
A 2/3 majority. Check.
That board selects the most powerful regional voice in national monetary policy.
The permanent FOMC voter. Check.
And the institution's primary operational focus in a crisis is to protect the liquidity of its largest members.
The repo interventions. Checkmate. It's a highly sophisticated, government-chartered mechanism for self-preservation. It isn't a simple profit-making business, but it's a utility designed to guarantee the house can't lose.
And the ultimate takeaway is that the currency you earn, save, and spend is issued by a mechanism with this powerful structural conflict of interest at its very core. The rules of the game are written to ensure the biggest players on the board always have a safety net. So after this entire forensic investigation, after digging all of this up, what does it all mean for the person just trying to get by, save for the future, pay their bills?
I think the single most important implication is about sovereignty, financial sovereignty. Once you understand that the monetary system is structurally biased, that it was designed by bankers for bankers, then simply trusting the currency they issue becomes a conscious risk.
You can't just passively hold their currency if you believe the system is designed to protect the house first. If that's the case, your most logical move is to stop keeping all of your savings in their chips.
Exactly. You need to diversify away from that ledger, away from a currency whose supply and stability is managed by a board with these inherent conflicts.
This isn't a call for, some kind of political upheaval. It's much more personal than that. It's a call for economic independence.
It's about being a critical thinker about what money actually is. And we would encourage you to seriously consider owning assets that exist outside the Federal Reserve's direct control. Assets that can't be devalued by policy decisions made by a board elected by these 71% owners.
The challenge we want to leave everyone with is this. Start thinking about how to be your own central bank. Stop putting 100% of your faith and your financial future into the US dollar, which is, at the end of the day, a liability of this very system we've just described.
Look at assets that have stood the test of time. Gold and silver have been money for thousands of years. Look at tangible, real assets like productive land.
And you have to look at the emerging digital alternative, Bitcoin. It offers a decentralized, transparent ledger that is free from the control of any central bank, any government, or any group of 71% shareholders.
The future will belong to the owners of real productive assets, not to the savers of a currency whose primary mandate is to protect its issuers. When the structure is this biased, the power has to shift back to the individual.
And the first step is making sure your wealth is outside that immediate sphere of influence.
Understanding who controls the system is step one. Achieving genuine financial independence is step two. If the regulator is structurally bound to serve its private shareholders, you need to own assets that are beyond its reach.
So here's the final thought to mull over. If you knew with absolute certainty that the rules for any game you were playing were secretly written and constantly overseen by the players who had the most to gain, would you keep playing that game by their rules? Or would you fundamentally change your strategy? Think about that.